I'm Adam Grimes. I'm the CIO of Waverly Advisors and partner at MarketLifeTrading.com. You can find more of my writing on my blog, adamhgrimes.com, and you can find my books on Amazon, and you also should be following me on Twitter at Adam H. Grimes. So the topic today is the yield curve. We've been reading a lot, hearing a lot in the news over the past few months about the yield curve inverting and how this could be a very bad sign for stocks. And sometimes I mention the yield curve on blogs and tweets, and I always get a lot of questions. So I see that people need some basic background. What is the yield curve? How do we think about it? And I have a really cool visualization here that we can go back and look at history, at how the curve has moved, and see if we can understand what's likely to happen in the future. So let's jump right in. You can have a yield curve for many different instruments, but usually when people talk about the yield curve, they're talking about the U.S. Treasury yield curve. And one of the most common ways to visualize it, think of it like this. You can loan money to the government. And you can loan money to the government and say, hey, I want it back in 30 years. I want it back in a few months. And so these are different maturities for loans that you or anybody, company, another country might make to the U.S. government. Now, it makes sense if you think about it. Here, this is not the full explanation, but it'll get you most of the way to the correct intuition. If you're going to loan somebody money for longer, you're going to demand a higher interest rate because a lot of things could happen. It's not necessarily that you're going to make more money from the longer loan because you're going to be collecting interest longer. Yes, that is true. But just in general, longer loans, you would expect tie up your money more. You're going to have a higher interest rate. So what we can expect to see if we take each of these maturities, and you can see the maturities are along the bottom axis, and we graph the interest rate at any point in time, we get a curve. That's the yield curve. That's all it is. And look at this kind of orange dotted line. I think maybe that's a good one to start with. So this is a typical upward sloping yield curve, meaning that it slopes upward toward longer maturities. And this is what we think the normal shape of the curve probably, quote, should be. Now, you see here, there are curves. If you look at the dates, the curve is not stable. It changes a lot. It moves up and down, and that should be one intuition. If the curve stayed the same, let me just kind of draw two curves. So look at these red curves here. By moving up, what this shows is that all interest rates would be at different maturities would be raising an equal amount. So the movement up and down along the vertical axis shows the overall increase and decrease of rates. And you're going to see that in the visualization I have in a moment. But we also can have other things happen. So it could happen, for instance, that for some reason everybody demanded almost exactly the same interest rate for every maturity. That would be a flat curve. And it could sometimes happen that people demanded more money for near term, and this is what we mean by an inverted yield curve. And the assumption, what we're hearing in the news, is that when the curve goes inverted, so meaning that this short end goes higher than the long end, that historically has been a very bad time for stocks and for the economy. So the first problem we have with this, if we're going to start to evaluate this, is we have one of these yield curves for every day. And each of these curves includes a lot of data points. So you're not really, it's not a piece of data that you can just look at and wrap your head around easily. That's why we need this kind of complex visualization. But I do want to show you here, this is the slope of the curve, and I've calculated it two different ways. So one of the ways is I've just drawn a line basically from the long end to the short end. I'll go back to these curves here. And so what I've done here is kind of average the long end of the curve. Again, we're looking at the dotted blue, and then have just taken the difference of these. So if this, to use round numbers, is 3%, and this is 0.5%, that's not what the graph says, but just easy numbers we can work with, then I would get the slope as being plus 2.5. So I'm subtracting the short end of the curve from the long end of the curve. The other way that I've calculated it is much more complicated, but you're going to see it's almost the same. And that's to draw a linear regression line through every point on the curve. And the blue is what I've called the difference curve. And that's what we're going to work with for most of this presentation, because I think it's a little bit more intuitive, it's a little bit easier to understand. But you can see that the shape tracks quite closely. And the one thing that you do need to be aware of, the blue axis is here. So this is the zero line. There's not really a line on the chart. This is the zero line for the blue, and this is the zero line for the gray. They're actually scaled on different y-axes. And this will clear up in a moment. So the first thing we notice is that going back to 1990, and we might ask the question, is that long enough? Should we be going back in deeper data? But let's just work with the 1990s for now, because we can get some good understanding. There are really only 2 points where the curve went inverted. And this occurred in late 2000, mid 2000, late 2000, and also occurred around 2006, 2007. Now, just from a casual understanding of recent market history, you know that those were 2 bad times for the market, bad times for the economy, and there was a lot of stress in the system in both of those times. So the 2000 was the dot-com bust, and then 2007, 2009 was the financial crisis. So yes, at first glance, it seems like we do have something here we should be a little bit concerned about, or at least to tell us maybe we should dig deeper. I would also point out there were a number of other crises around the world where we don't really see much of an impact on the yield curve. And if we're looking at a very crude way to think about the curve, you might, looking at this chart, you might think that there are some other things that we could think about. Like we could look at the velocity of the curve. We could look at how long it hangs out around specific levels. Yes, this is, these would be correct things to think about. But just to give us some idea of what the data has looked like historically, knowing that, it's also worth noting that, is this really a level today? So think about all of the news articles we've seen talking about the inverting yield curve and how we should be very, very worried. So we've just seen, maybe we should be concerned if the yield curve were to invert. But the question is the yield curve inverting? And based on the historical record, no. You'll see the visualization in a moment. There's a lot of noise. There's a lot of fluctuation in the data. And currently we are not anywhere near the levels at which from which we have seen stress emerge in the past. Now, here, this is really interesting. Many of you probably knew everything I just told you. You probably have not seen this though. So what I have here, and I'm going to just page through the data. We have the yield curve on the left. And I do have the difference slope here down at the bottom, so you can see this number change. And then I have the S&P 500 on the right. And I also have some look forward stats down at the bottom. This tells you what the S&P return was 1 quarter out, 6 months out, and a year out. And these are just point to point, so there's a lot of noise in this. And then the S&P chart, this is kind of interesting, at least I think. The grayed out area is the future. And if you go through and check very carefully, you're going to see I might be off by a week or so, but that's because just the way the data works in Excel. But roughly, this yield curve you see on your left is what people saw here right at the border of the gray box, and this is what the future held. So we start out back in 1990, and I'm just going to page forward a little bit at a time. And what I want you to see is how the curve changes and all of the many different shapes the curve can take. So I'll just kind of page through here. We can watch. You see I'm jumping by roughly a month every time I click. And if we went by a day, you would see that the change is much smoother. So here so far we have our kind of standard yield curve, which is kind of doing what we think it should. And notice the stock market kind of does what we think it should. I'll just fast forward here. And you might want to watch this and think about history. It's interesting to think what happened when you just click through whole years at a click. So here we are coming into the mid 90s. And notice there, did you see what happened? So if you compare the shape of the curve a while ago to what we have now, we're seeing a lot of flattening. We're here in the middle of the 1990s. Here the curve goes almost completely flat. Still pretty good future for the market, right? Very close to flat there. So this has made one of the major points I want you to take away from this is that there's a lot of fluctuation in the shape of the curve. And a lot of times when the curve has kind of almost flattened, and here we are in the late 90s, a little bit of flattening. So now let's go a little bit slower here. Okay, here we're starting to see some serious belly in the curve. Let me page back. So even if the actual slope is not quite inverted, we do have a big bump in the belly. And this is a point where the market is coming into some stress. And here's a point where we actually go inverted. Now, this is here. And this forecasts a pretty bad time for the market. Notice, I don't know if you've been watching the 1-year return, but we're finally negative, and that does not really happen very much. We'll talk about that in a moment. So we touched inverted there, kind of flirting with inverted. This is an inverted curve right here, late 2000. Check out the shape of the yield curve. Okay. Very bad year ahead for the market. And then the curve normalizes. Market's still enduring a shock. Remember, we're right here in history. Curve normalizes. Market has stabilized. We're now still in the early 2000s. Very standard. This would be a typical textbook yield curve shape. Curve appears to be moving toward flattening, but we've seen that before. Ooh, look at that. Now we're flat, very close to flat. There, we touched inverted. So here we are, mid 2016, we've touched inverted. Still some okay times ahead for the market, but we all know what's kind of just around the corner, right? And here is a very tough time for the market. At which point, so the curve anticipates this. You see the curve is already stabilized. And here we are, 2009. So it's kind of a typical pattern there, and then I'll page through because frankly, from 2009 to today is not really all that interesting, except to notice one thing that, well, I shouldn't say that, right? Because one thing that has not happened before in history is the short-term rates go to zero or very close to zero. So one of the things, if we're going to consider the shape of the curve today, we don't really have a lot of data where that short end of the curve is coming off of such low rates. And here we are, 2016, starting to see a little bit of an increase in rates. And here the whole curve goes up a little bit, and this will just about slide into current data. So that's what I really wanted to highlight. The look at what has happened historically when the curve has gone inverted, and to relate the shape of the curve today, we don't really see that. If we go, let's page back now that you've seen all of those historical shapes, you see that it's really hard to look at the more or less current shape here and to say that looks like anything other than just random fluctuation of the noise. Let me show you one more visualization. Let's talk about some stats. So this messy graph is a scatter plot, always looking at the return 250 days forward on the y-axis, and this is the slope that we saw underneath the graph as a single number. And what I want to point out is that, so if you look at the market return, here's 0. So everything below that line means you would have lost money a year later if you bought stocks. These are daily data points. Now you can see that whether the curve is inverted or not actually does seem to have an impact. When the curve is not inverted, yeah, some really bad things happen. We had some 40% years and the curve was not inverted to forecast that. However, I would point out two things. If we look at the really good things that happened to the market, they did not happen while the curve was inverted. Let me remove some of these lines. So now we're looking at everything to the left of this. Let me actually draw a straight line. Everything to the left of this line is the curve inverted. And everything to the right is the curve in that normalized state. So these really good market returns did not occur to the left of the vertical line. And if we look to the left of the vertical line, in fact, we don't really have a lot of high returns. It seems that most of the returns cluster under 0. And this is, in fact, true. If we look at the data, and I'll pull up a summary table here. So one of the things we can look at is just a simple binary stat. Is the market up a year later? And if we ask that on every day back to 1990, we find the market is up a year later 79.7% of the time. So anytime you just randomly bought the S&P 500, you would have been up 79.7% of the time. If you had bought when the curve was inverted, you would only be up 31% of the time. That's a pretty big difference. And if you bought when the curve was normalized, of course, the number is 82. That is a significant difference. The other thing to think about is what's the magnitude of that return. Well, if you just bought on any day since 1990, your average return 1 year later would be 9%. The actual number is 9.05%. If you bought when the curve was inverted, your average return would be negative 7.1%. Now, I'll tell you something from a system development standpoint. It's actually hard, quite difficult to find a signal that forecasts negative stock returns. You'll find lots of systems that are statistically significant, meaning that they underperform that 9%, but you'd still lose money being short. For instance, you might find a technical signal that only is a positive 4% when you have the short signal. Well, if your baseline drift is 9%, that positive 4% might be statistically significant. You found something, but you might not. You would have lost money trading it, so it's not economically significant. Another thing that we might think about is, and this one surprised me, the volatility. I expected to find that the volatility would be higher when the curve was inverted, the forward volatility. And if we look at the average volatility 1 year later, if you were to look at it when the curve is normalized, then the average standard deviation is 0.0100. That's not annualized or anything, just a raw number. And when the curve is inverted, it's 0.0116. 0.0116 compared to 0.0100. So it's a little bit higher, not massively. I expected to find a much stronger effect there in the volatility. And I suspect the reason that we don't, higher volatility is correlated with negative returns in stocks, and the normalized yield curve also has its share of kind of ugly things that happen. So I hope that was useful. I know it was a little bit nerdy, maybe a little bit too much into numbers perhaps for some of you, but the bottom line is that yes, an inverted yield curve has in the past shown us times when the market is going to come under stress, and when we see an inverted yield curve in the future, we should be perhaps concerned, but we see no sign of the yield curve inverting showing nothing that we're seeing currently looks like anything other than just random fluctuation in the noise. And it's further complicated by the fact we're coming off of such absolute low levels of interest rates. That's something we have not really seen in the historical record. So that is all I have for you in this blog. Go check out my blog, adamhgrimes.com. Follow me on Twitter at AdamHGrimes. Thank you very much.